Algorithmic trading, automating market decisions with code. Agenda, trading execution models, algo trading history. Why algo trading? Order life cycle, getting started, basic workflow, strategies, and backtesting. Testing. Trading execution. Trading execution is the process of turning a market decision into an actual buy or sell order sent to an exchange. If a market moves quickly, execution speed and consistency often matter as much as the decision itself. Almost every modern financial market has some share of its volume driven by automated, rule based execution. Any strategy that needs to react to fast moving data benefits from execution that doesn't depend on a human clicking a button. Manually watching charts and placing every single trade by hand doesn't scale. Manual and algorithmic trading. Manual trading has a person watching markets and placing each order by hand based on judgment in the moment. Algorithmic trading instead encodes a strategy's rules in software which monitors markets and places orders automatically. Manual. A trader watches a chart, clicks buy or sell by hand, limited by human speed. Algorithmic. A script runs the rules, executes continuously, reacts in milliseconds. Problems with manual trading. Single point of failure. A trader can only watch so many markets, and fatigue affects judgment. Emotional decisions, like panic selling or chasing a rally, often override a strategy's original rules. Execution speed is limited by human reaction time, which matters in fast moving markets. Hard to test a strategy's rules constantly against years of historical data by hand. Manual execution doesn't scale across many instruments or markets at once. Misses out on the discipline that comes from mechanically following a predefined rule set. The algorithmic trading system. A strategy's rules are written in code and kept in a source or Git repository, just like any other software. A backtesting engine replays historical market data through the strategy to evaluate how it would have performed. Once validated, the strategy connects to a broker or exchange API, submitting real orders based on live market data. Common building blocks of an algo trading stack: a market data feed, a strategy signal engine, an order execution and risk management layer. Algo trading advantages: executes consistently, following the same rules every time without emotional interference. Reacts to market data far faster than a human ever could. Can monitor and trade many instruments simultaneously, something manual trading struggles to do. Strategies can be backtested rigorously against years of historical data before risking real capital. Risk controls, like position limits and stop losses, can be enforced automatically and consistently. Frees a trader's time to focus on strategy research instead of manual order entry. Everything is a signal, almost. One huge benefit is that in algorithmic trading, almost every decision reduces to a signal derived from data. A signal is simply a computed value, like a moving average crossing another, that the strategy interprets as buy, a sell, or a hold. Breaking a strategy down into signals makes it testable, since each signal's logic can be verified independently. Combining multiple signals lets a strategy weigh several factors before deciding to act. This signal-based thinking is what makes a trading idea something code can actually evaluate and act upon. Signals and orders. A computed value the strategy uses to decide what to buy. Order the actual instrument sent to a broker or exchange. A simple moving average strategy. This illustrative strategy buys when a fast average crosses above a slow one. Order execution with risk check. Before any signal becomes a real order, it passes through basic risk controls. History. Program trading emerged in the 1970s and 1980s as exchanges began adopting electronic order systems. The sixth approval of electronic exchange through the 1990s, the SEC's approval of electronic exchanges through the 1990s accelerated the shift away from purely floor-based trading. High-frequency trading grew rapidly in the 2000s as firms competed on execution speed measured in microseconds. Regulatory changes after events like the 2010s flash crash introduced new safeguards around automated trading. Today, algorithmic strategies account for a substantial share of daily trading volume across major markets. Why algo trading? Consistency. A strategy's rules are followed exactly every single time. Speed. Orders can be evaluated and placed in milliseconds. Scale. One system can monitor and trade far more instruments than a person could. Testability. Strategies can be rigorously backtested before any capital is at risk. Discipline. Automated risk controls remove emotion from position sizing and exits. A mature ecosystem of data providers, broker APIs, and open source tools supports the practice. The backtest engine. A backtest engine replaces historical data through a strategy to estimate how it would have performed. Results depend heavily on realistic assumptions about fees, slippage, and order fill timing. A strategy that performs well in a backtest is not a guarantee of future results. Never treat a backtest as financial advice or a promise of profit. Market change and past performance doesn't guarantee future returns. Algo trading life cycle. Compute indicators. Signal. Check limits. Risk check. Submit to broker. Order. Fill confirm. Execute. A signal is computed from data, checked against risk limits, submitted as an order, and finally confirmed once filled by the exchange. Getting started with algo trading. This leads us to the three steps before any real Capital is involved. Choose a platform. Pick a broker API or trading platform with programmatic access. Backtest a strategy. Test your rules against historical data before risking capital. Paper trade. Run the strategy on live data with simulated money first. Basic workflow. Algo trading. Signal. Operation on signal with limits. Future returns may vary. Backtesting, paper trading, and going live. Some call backtest, paper trade, and go live algo trading's everyday loop. Backtesting validates a strategy's logic against years of historical data first. Paper trading runs the exact same code against live data with no real money at risk. Only after both stages build confidence does a strategy typically move to live, real money trading. Risk controls and position limits stay active at every single stage, not just backtesting. Supports many workflows, single strategies, multi-strategy portfolios, market making. This is educational content about how these systems work, not financial advice or a trading recommendation. Any questions? Thank you.